Happy Friday, traders. It is Friday, the 6th of September, 2019. Thanks for joining me today on this non-farm payroll Friday. This is episode number 1590. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, as you may have seen, non-farm payrolls came out, and a fair number of releases came out overnight. Non-farm payrolls being the most important for the U.S. market, and it came out worse. The change, the unemployment, the non-farm payrolls change came in at 130,000 versus 160,000 expected. The unemployment rate stayed in line at 3.7%, and net change in hourly earnings came in at 0.4, or average hourly earnings came in at 0.4% versus 0.3%. So wages slightly higher. And of course, we have a tweet from President Trump at 5 minutes before the NFP stating that the Fed should lower rates. He agrees with Jim Cramer. They're way too close to raise, and way too early to raise, and way too late to cut. And a big dose quantitative tightening didn't exactly help either. Where did I find this guy Jerome? Oh well, you can't win them all. Criticizing the Fed chair. Also, I think previously he called him the first enemy of the country in terms of the economy. Of course, president's looking for re-election, and the economy is a big part of what people decide on in terms of presidential candidates. So he wants a rate cut fast and hard. So expecting Kramer to serve in the next administration, I guess. Um, so we're looking at the Russell, the small caps leading this morning up 0.55%. The reaction off of the non-farm payrolls was in the ES was pretty not much, around 5 point drop, and then it went up 5 points from the SOC, and now we're trading below where the number was released. Um, and uh, and money seems to be flowing into the small caps, which have been really lagging and still are. The DAX is next. The DAX is the next strong asset that I'm monitoring. The S&P is up about 10 points, or 0.33%. Crude taking a hit. It went way up to 57.90, maybe 57.80, and it's currently trading at 55.14. It came off yesterday after a strong move up on non-farm payroll day, and it's retraced a lot of that. As I said in the Convergent chat, the Convergent Head Trader chat room, I'm expecting crude to continue to roll lower as these news events are not keeping prices higher. You gotta believe the tape, what the tape says, and the tape is saying that it's not able to sustain these prices above 57, not even 56 at this point. So that's where we stand. Risk on this morning slightly. We are trading inside of yesterday's range in the indices, and it's looking like it's likely to be a sideways day, in my opinion. We have a gap up and go day before yesterday. We had a gap up and go yesterday. We had two days where we did not breach the IB high or the IB low, which historically has a 98% probability of being taken out, breached during the session, the IB high or the IB low. 98% historical probability, and we've had 2 days this week where that didn't happen. I'll talk about that in a minute. And that's where we stand. In terms of what's ahead, we do have Fed's Chair Powell speaking at 12:30 Eastern. I don't know what his speech is about. I didn't look into it. I'm not sure if he's going to pre-release text, But I would say that pay attention again, 11:30 Central, 12:30 Eastern, expecting Fed's Powell to come on and make comments. And then on Saturday, tomorrow evening, even though our markets are closed, China releases its balance of trade, exports year on year, and imports year on year, which are significant figures. So expecting that to get reflected into the Sunday open. Looking for potentially a strong potential for a gap there. Looking at what was expected yesterday, surprisingly, of course, it's hard to see because I chose a really crappy color. I'll do a better job next time. Surprising to see that the scenario that played out was more scenario 4 than 1 through 3. Scenario 4 was an open test down, drive up, and it didn't even test down. It did very, very small, and it ended up pushing. I was looking for a drive to push into 29.80, 384. And what we actually got yesterday was this. Here's what we have. We have a market that opened, pulled back slightly. I mean, it's hard to qualify that as a test. It was about a point and a half drop, and then we had a very clear drive up, a push up. The opening was more of an open auction out of range, to be honest with you. It traded both sides. It retested the opening print, and we put in a high 29.86, and just from there, it just flagged. And what's happening here, it appears to me, is that the news is generally occurring overnight, and so we end up with these gap and go situations or a lot of gap ranges. And yesterday's gap range was 100 ticks. The gap zone's 100 ticks in ES. It's a lot. And so what we do is we complete our business by pushing hard from the get-go. And we're talking about 25 points. Yesterday's range was 25 points, and that was put in the first 45 minutes. And that's a fair amount. And then from there, we go sideways. Now, here's the thing. When we look at where the market has been, this is very important. Where has it been? Where is it? What has it done? What is it trying to do? And how good of a job? Okay. When we look at this is the SPX. This box here has been around and has been watched by everybody for a long time. Okay, for the entire month of August, we've had this box and we've broken above it. The issue is that when you look at the macro picture, which a lot of the bigger funds, the big money in the market, the OTF money is looking at, when you look at the macro picture, it is saying that there's a dollar shortage, there's instability, there's probably not going to be that much growth globally, blah, 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 blah. Gold's moved up $200 over the last 2 months or so, 400 and some odd dollars over the last year. And so it seems like money's moving into safety and the dollar's not coming off, which also is odd, but there's, an explanation for that. But where it affects us is that as it breaks higher on this consolidation, you have a kind of a conflict. If you are a huge fund manager, there's a conflict here because traditionally you would see the breakout out of consolidation as a bullish signal and you would get long, right? It would trigger long and we would be aiming for all-time highs in this situation of 30.28 on the SPX cash index. But the overall macro picture really is looking kind of bleak. Why would the Fed cut? Why would the Fed cut on a picture that is sustaining growth, right? That is positive, that is bullish. Why would the Fed cut? And so what happens here is we break higher on news, Hong Kong and the conversation between the U.S. and China resuming. That news came out at the same time yesterday or the same period yesterday. And so Do I want to short it based on bleak news and the fact that the Fed is intervening and reversing its position, or do I want to get long a breakout like I normally would? I'll just not do anything. And so what happens when that happens is that you have a gap with a wide range. So you have the systems that kick in, but then there isn't this follow-on bigger picture OTF type move that comes and continues the move up to take us to our next target. Not yet. And so we get the job done in the first hour, and then we sit around all day. And that happened on this day, that happened on Tuesday, that happened on Thursday. There's only one instance in the last 10 years where in the same week we had two non-trend days or days where there was no break of the IB high or the IB low. It's just very telling. I found yesterday to be quite choppy. It's a bit of a scalper's kind of heaven. There's a lot of order flow based setups that came up yesterday that were kind of obvious that if the market's going to go sideways, I'm just going to lean on any push above prior highs or lows and ride it back to the middle. But overall, it's just not doing what it's not giving off good structural signals. Here's what it looks like. I mean, we have a large gap right underneath us. We had an additional gap a couple of days ago. In an auction market, this is not very stable structure, right? This is kind of like building a wall and skipping a few blocks, cement blocks here and there as you're building the wall. At some point, the structure kind of the structure comes back at some point. The structure is likely to be repaired. Somebody's going to come back and fill in those empty spots to strengthen the move, and that gives us an opportunity for a test below. I'm not saying we'll sell today, but this is what's setting up. So that's where we are. A normal distribution chart yesterday, despite the early push, it did look like it was likely to be a trend day. And it's a normal distribution. We had a normal distribution yesterday, so pay attention to value high, value low, and that's where we are. In terms of what we've got overnight, the overnight session tested a little bit lower and ended up spending almost the entire session above the close. Above the close, and that tells us that the overnight inventory is more likely to be long than short. The non-farm payrolls release has an SOC, or the scene of the crime, at 2894.50, and we've tested above, we've tested below, we've tested above, and we are trading below currently. Note that mid and VPOC right on top of each other. VWAP's a little bit higher, and this could go in either direction. All of that being put together, it tends to have me believe that that we are likely to go sideways. Oops, hang on. This is not the full depth. So this is the full depth picture here. We open up, we push up, we go sideways with a slight positive skew. And we get non-farm payrolls right in here, 84.50, right up here. We test lower, we test down. We have a kind of a three-wave move, but it's broken, and then we start to push to the upside. So the initial wave down, we expect a pullback, we expect a continuation wave. We want to trade that continuation wave. And then it ended up going back above the point of the release and going sideways before it started to release to the upside. There's liquidity up in 29.90 and 29.92-ish. That is stable liquidity, has been there a while, as well as 29.95. and then below is 29.72, and in between you can see that there isn't all that much there. 29.72 is yesterday's close. I expect it to bounce off of there on a first test, at least provide a 3-4 point rotation there. So the liquidity picture, the order flow picture is really not saying all that much either. And that's how things are setting up. And this is why I believe we're likely to see a pretty summer-like session. You know, we've gotten things out of the way. We're likely to see a move on the open. We're likely to see OTF, or the bigger time frame traders, step in on the open, and then we're likely to just kind of hover sideways. What do we have for today? Well, before we talk about that, as always, those who've been listening for a while know that I'm going to throw this at you. Please take a moment to hit the like button on YouTube. If you're on Periscope, you're excused. You should be on YouTube. But hit the like button, and it's Like Friday. Let's look at what we expect for today, what I'm looking for today. This morning, we're opening above value in range. So in range above value. As I said, the overnight inventory is long. There's a high probability that this is likely to revert back. I'm looking for it to move back towards the 29.75.50 point of control, consolidate, and then push into 29.72 before it gets some buyers. I expect a pretty much sideways day. As I said, we had 25 points of range yesterday. I'm expecting lower range today. The ideal situation is it consolidates, it finds its buyers down here, and then it starts to squeeze that high uh, squeeze that high to start moving towards, continuing the pop and go play that we started with yesterday. The secondary scenario is the opposite. The secondary scenario is also chop that continues to drift up from before the non-farm payrolls release, gets up there, and then takes out the high, finds sellers in the 29.93, 94 area, comes back in range, gets to the point of control, and just sits here into the weekend. Again, it's Friday. We're coming into the weekend expecting a lazy Monday. Non-farm payroll, the Monday after non-farm payrolls statistically have a lower, the range is always on the lower side of the first standard deviation. So expecting that to be quiet. I'm looking for business to be done early and for people to move on from there. So what's going to help determine this? I would pay attention to the first 15-minute bar relative volume. So how do I track that? It's tracked down here, right here. These black bars are the 20-day mean volume, 20-day mean volume for that time bracket. Since this is a 15-minute chart, it's basically looking at the last 20 15-minute volume blocks over the last 20 days, 20 trading days, and it figures out the average and plots a black line. The white and the orange are actual or current. And what's likely to happen is we're likely to see a long black line. It won't be that much different than this one, and we might see volume at half or lower or whatever, 60% or lower, and that's going to tell us how much participation there is on the open. As you could see yesterday, there wasn't very much, and that's why I classified it. Part of why I classified it as an open auction out of range. And then volume picked up as the run up happened. You could see the volume exceeded the 20-day mean volume for the second, third, and fourth 15-minute bracket. This morning, I'm going to be paying very particular attention to the first 15 minutes to see how much volume participation there is. If it's lackluster after a release as big as a non-farm payroll, then I know that I need to chill. I need to kick back I need to be selective for the day. It's not likely to be a very active day. Okay. So I leave you with that. Good luck today, and I'll catch you on Monday morning. Take care.